For 12 episodes, we have been building one quiet argument. For most people, buying a cheap, broad basket of the whole market and holding it for decades is the smartest thing they will ever do. And that is still true. But maybe a part of you wants more. Maybe you want to look at a single company, a real business, and decide for yourself whether it is worth owning. That skill has a name. It is called fundamental analysis. And today we take the first real step into it. Start with the big fork in the road, because there are two completely different ways people study a stock. The first is technical analysis, which you met back in the trader episode. It stares only at the price chart, the squiggly line, trying to guess the next move. It does not care what the company does. The second way is the opposite. It ignores the chart almost completely and asks one grown-up question instead. Is this a good business? That second way is fundamental analysis, and it is the language of a long-term investor. This is not a new fad. It was carved in stone almost a century ago. In 1934, two professors, Benjamin Graham and David Dodd, wrote a book called Security Analysis, and it became the Bible of judging companies by their actual worth. One of Graham's students at Columbia was a young man named Warren Buffett, who took these ideas and turned them into one of the great fortunes in history. So when we do this, we are walking a very old, very well-worn path. Here is the mindset shift that makes all of it click. When you buy a share, you're not buying a flashing ticker. You are buying a small piece of a real business with employees and products and customers. So the question is never just, is the stock going up? The question is this a good company, and would I want to own a piece of it for the next 10 years? Fundamental analysis is simply how you answer that, calmly and on purpose. So where do you start? Not with numbers, with the story. Before a single spreadsheet, you should be able to answer the most basic things in plain words. What does this company actually do? How does it make its money? Who are its customers, and why do they keep coming back? Peter Lynch, the legendary investor, put it perfectly. Know what you own. If you cannot explain the business in a sentence or two, you're not ready to judge it yet. Understanding always comes before math. And here's a question the great investors obsess over once they understand the business. Does this company have a moat? A moat is any durable advantage that protects it from competitors the way a moat protects a castle. A powerful brand people trust. A technology nobody can copy. A network so large it is impossible to dislodge. A company with a wide moat can defend its profits for years. A company with no moat gets its lunch eaten the moment someone cheaper shows up. You're not just looking for a good business today. You're looking for one that can stay good. Now, once the story makes sense, we are finally allowed to open the numbers. And the numbers live in 3 official reports every public company must publish. Today, we focus on the most intuitive one, the income statement. Think of it as the company's report card for the year. It answers one simple question. Did this business make money or lose it? The income statement starts at the top with a number called revenue. Revenue is simply all the money that came in from selling things before any costs are taken out. People call it the top line because it sits at the very top of the report. The first thing a fundamental investor checks is almost childishly simple. Is the top line growing year after year? A business whose sales keep climbing is usually a healthier story than one whose sales are shrinking. But revenue alone can lie to you because running a business costs money. So you travel down the report, subtracting the cost of making the product, the salaries, the rent, the taxes. And what survives at the very bottom is the number that truly matters. Profit, also called net income, or simply the bottom line. This is the money the company actually got to keep. A company can have enormous revenue and still lose money if its costs are even larger. Revenue is the promise. Profit is the proof. There is one more number worth knowing because it connects the company back to your slice of pizza. Take that total profit and divide it across all the shares that exist, and you get earnings per share, or EPS. It is simply how much profit belongs to one single share, your share. When you hear that a company beat or missed earnings, this is usually the number everyone is staring at. Rising profit per share, year after year, is one of the clearest signs of a healthy, growing business. Now, a crucial warning before you run off feeling like an analyst. Everything we did today tells you whether a company is good. It does not yet tell you whether the stock is cheap. Remember Benjamin Graham's other great lesson, the one about Mr. Market and a fair price. A wonderful company can still be a terrible investment if you pay far too much for it. Quality and price are two different questions, and today we only answer the first one. The second, the actual valuation, is where we go next time. So look back at where we started. 12 episodes telling you that you do not need to pick stocks at all. The index will do beautifully. That is still the wise default. But now you also hold the first half of a real skill. You can pick up any company and ask, in plain language, what does it do? Does it have a moat? And on its report card, is revenue growing and is it actually making a profit? That is fundamental analysis, the first half, and it is the same question Graham and Buffett have been asking for 90 years. I'll see you in the next one, where we learn what a company is truly worth. Until then, keep it simple and always understand the business before the number.